The first primary benefit of the trust structure is the ability to distribute income and capital gains to beneficiaries. If you're going to use that equity for acquiring a deductible or income-producing asset, then that interest is deductible. Once you set up a trust to purchase a property, and if you've got a negatively geared asset, then you don't get the benefit of the gearing because the trust cannot distribute losses. The trust is a very unique structure. It has various tax benefits. If you use it properly, it has a multitude of benefits for you.
In today's episode, we're catching up with Ronesh from the Incentum Group. Now, Ronesh's accounting background and expertise, and the work he's done with many of our clients at InvestorKit, is all going to be on display today as we go into the world of equity loans and trusts. Now, it's really important that we go into these particular worlds to help you as an investor learn more, but be more compliant and understand the way you're scaling your portfolio in the right way from a tax perspective. It's mistakes that people make so often, it stresses their accountants out, and if anything that comes up in terms of tax rules, are you following it or not, this is the episode to tune in and learn more about, especially when it comes to growing a portfolio using equity and using trust. So make sure you stay to the end where we'll uncover more on trust and even the thresholds, because we've had some interesting learnings from Ronesh on discretionary versus family trust and the thresholds there for tax in investing in, say, New South Wales as an example. So tune in, stay until the end where we cover off more. But most importantly, remember, when it comes to accounting, this is a general chat and it's not your personal or financial advice. Go speak to an accountant, speak to a financial planner to make sure you're educated on all the rules as they're constantly changing. And even this time that you watch this episode, things could be different weeks, days, months later. So go and get that advice. But for now, let's tune in.
Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Ronesh, welcome to the show, my friend.
Thank you, Arjun. Thank you to the team at InvestorKit, Jack and Adrian. Nice to meet you guys again.
Yeah, well, we catch up often and we talk a lot of things on client scenarios. We pick your brain often. And this time we've actually got a lot of questions submitted from, clients, our team, just to make sure we're sharp as possible in the world of accounting and getting your expertise here. But one of the most common things is equity and equity loans in particular. So when it comes to people taking out equity loans and then looking to, invest or maybe do other things with it, what are the most common mistakes you see when it comes to people taking out equity loans from an accounting and tax perspective?
Sure. That's a very good question. We see quite commonly, people are talking about equity in their own homes and their friends and the brokers say there's equity, you should be able to access that. So that's entirely not a free pool of money. It's still going to be, a loan that you need to service and it's a debt that needs to be paid. So it actually comes down to the end purpose of that equity. If you're going to use that equity for acquiring a deductible or income producing asset, then that interest is deductible. Whereas if you're going to use that equity for instance, a lifestyle purchase, purchasing a car, your favorite Lamborghini or something like that.
Or a boat.
or a boat. Yeah. So then that equity, the connection to an income producing asset is not there anymore. So you can't claim that interest. So it's all about structuring your equity correctly. So you need to make sure that you've got a proper documentation around when you're extracting that loan from your property, making sure that it's connected to the income producing asset. There is a document linking the connection for it. So that is what I think is one of the implications.
Yeah, getting that purpose right seems to be the common theme, right? Just making sure you're not spending it on things that you say are income producing but aren't, and then you're not spending it on things that aren't the assets that income produce, but then you want it to be a tax deduction, right? So very fair point that it comes down to the purpose.
Yeah. So people don't really know this, but could you speak to a little bit about the difference of accessing equity on an owner-occupied property versus accessing equity on an investment property? Because I know a lot of people have the preference to say when they want to purchase an investment property, I want to access the equity in my investment property. Or but you've got a lot of equity on your own occupied property. You can still access it from there because, like you said, it's all based on the purpose. So Could you talk to, conversations you've had with clients about that?
Yes. We've had conversations about clients for both investment and owner occupied. It comes down to a few things to consider. It comes down to risk, comes down to tax deductibility. Also, it comes down to serviceability of the debt as well. So where entirely, if you're focusing on one, then you kind of most probably not achieving your entirely balanced goal. If you consider all three with respect to your situation, your financial situation, the assets you want to acquire, and the deductions you want to achieve, and again the negative gearing, if there is, that's going to impact your personal tax situation or your other entities. All of that has to be considered in totality rather than just focusing on one aspect, if that makes sense. Yeah.
Jack, coming to you on this one, when it comes to equity loans from a owner-occupied, does the bank look at that differently from a servicing perspective? Do they go, oh no, you took it out from there, so we service it differently? Or do they look at it more on, again, purpose-based, similar to what Ronesh is saying?
So it comes down to negative gearing. So if you're accessing an equity loan on your owner-occupied property, if you're using it for an investment property, they'll still allow you to negative gear that in the servicing.
Got it.
So it's all based on the purpose.
Purpose seems to be the common theme.
Unless it's being used for a property in the trust, they don't allow you to negative gear that.
Which is that's another can to open up.
Yeah, I think, now that we've talked about equity, I think what we see a lot in the strategies that we build out is people constantly tapping into equity, usually, the first time, but also it can be multiple times and creating multiple loan splits, and things can get a lot more complicated. Jack and I were just talking earlier before about making sure that we're keeping track of the equity and everything like that, and it can get a little bit confusing. So from your side as an accountant, what's the best way that we should be keeping track of the equity splits, the loans, and all of the
just
complexities?
Leave it up to the accountant, mate.
Just keep track. That's your problem, Ronesh. We just chuck it over there. Here's my statement.
Now, that's a very good thing you pointed out there. A lot of people who actually tap into equity bundle all their loans into one home loan or one REIT or facility. So that makes our life quite difficult from a tax perspective, because we want to see clarity. We want to see which loan is connected to which property and the interest on those loans, because it's a matter of deciding what is deductible and what's not deductible from a tax perspective. So if you've got loans for personal and loans for investment in the one facility, then it's quite muddy and messy, and it's quite expensive for us to spend extra time trying to distinguish between the two. And again, the tax office is quite strict about that as well.
Is there a way that you could pick up on that, though, when you're doing a tax return? If someone sends you a loan, it's like, what's the point of where you figure out that, hey, that you're trying to claim too much interest for what you paid for that? Like, is there a way that you could figure that out? Like, I don't know the technical side of doing a tax return, but have you seen that come up where a client just sends you a loan and you realize the loan is too much for what you basically paid for the property?
Well, our team of accountants usually analyze the loan statements, and where we pick up various amounts differing in terms of value, it's not consistent. So that triggers a bell to us, and we ask questions and queries to our client. What are these payments for? Where we see consistency, regularity, then we know that, okay, it's meeting the loan requirements. The loan schedule is correct at the end of the day. But that's a good question that you've raised. I would want to further add is, we've got clients who usually think that they need to talk to their accountants at tax time, but that's usually not the case. So where the client is decided that they want to draw out equity, they should give their accountant a call, say, what are they using that equity loan for? What sort of asset they're purchasing? And we would guide them to say, do it this way, structure it in a correct way, make sure the funds go into the relevant asset, and you can see the trail from the origination to the actual purchase of the asset.
Are there any tips you have when people are structuring bank accounts or ways to present statements or things like that when it comes to equity management? For example, someone with 5 or 6 properties, do you have the system where you go, okay, multiple offset accounts or not, or loan splits all separate or not? Do you find there's a bit of a best practice that you go, my happiest clients, they do it this way and they're the easiest to work with? And the ones that, have some strife in tax time and audits or anything like that have this issue? Is there some best practice tips that you think could be followed?
There is some of our clients who follow it by the treat their investments as separate businesses. So they make sure the records are there. They make sure the bank statements, the loans are in the correct entities. It's just being disciplined, making sure that you're not using those loans for personal use, and just adhering to it at the end of the day.
Yeah, really important. Now, this podcast is called The Property Nerds for a reason, because we love to nerd out, right? And when we nerd out, we get deep into some technical questions. So if you're following this far and you're into the show, we love it because you're one of us. Now, Ronesh, we know you're one of us. We love talking this stuff. So I want to go deeper into this equity piece. And the part I want to go into now is a joint owner. Example, a husband and wife own a property. They take out equity from their property, but then maybe the next purchase isn't in the husband's and wife's name together. It might be the husband's name only as an example, but you're using equity from a property that's owned joint. When it comes to that, how do these technicalities get looked at?
Sure. That's an interesting question. What we look at in terms of a property which is owned by a couple, for instance, it's the ownership. We look at the ownership at the end of the day. If it's jointly owned, then it's 50-50 pretty much. Then every deduction on the property is, shared 50-50 between the owners. There is a missed opportunity here in terms of higher income earners who could potentially claim more deduction and have a better effect of the negative gearing. So before, I guess, drawing out equity, people need to understand the structuring. They need to understand the ownership, whether it makes sense to have a bigger portion of the loan in the high income earner.
Like the 99.1% type of strategy.
That's correct.
That's awesome. Yeah.
Again, and then making sure that, where you source the loan from, making sure the documentation is done correctly. You can see the trail, like for a subsequent purchase of, if you draw down a second equity, then you need to see the connection between the second equity and the second investment purchase. So it has to be clarity. Documentation has to be up to date, and making sure that the end goal is met for the client.
So in that scenario there, I'm guessing because the equity released was joint, but the purpose for the next investment, coming back to purpose, was only in his name, would it still be just 50% of the equity of the first loan claimable for interest because he was a half owner on the first? Or is it 100% of the equity loan is interest claimable, but all to his tax return, not hers, in that scenario?
So in that scenario, if the second loan is entirely for the, for the one husband's purchase, and the ownership is in his name, and the loan is taken in his name, there's a second loan split, then 100% of that deduction on that interest would be in the husband's name for the second component, second loan.
Got it. And then what about that equity loan itself? Because it came from a property that was jointly owned by husband and wife 50-50. Is that equity loan only half the interest claimable because it's a joint property that it's come out from, but they've used it for a first one? Is that right? Or is it the full interest claimable, but to his name?
So you would do two set of calculations, which I think you do first a 50-50 because that initial loan is between the two individuals.
Got it. Yeah.
And then the second would be whatever that additional loan has gone to for the second purchase. And if that loan is also shown as a split loan, the ownership is in the husband's name, one person's name, then that 100% of that additional loan would be in the husband's name.
Got it. Yeah. So I think the key learning for everyone is, purpose is 1 point, but 2 calculations, not 1.
Correct. And it's, again, comes down to bank statements, loan documents, making sure everything is intact and conducted correctly.
Love it. I love how, we're probably the only people on the earth where this excites. So us, you know what I mean? A few of you watching, if you're in this same journey or listening to us, and you're like, oh, that excites me because I just figured out something. That's really helpful. Thank you for sharing, Ronesh.
Let's be honest, spreadsheet fatigue is real. That's why we introduced ARI, the Advanced Rental Income Calculator by InvestorKit. It's Australia's most sophisticated, user-friendly tool for analysing potential property returns, and it's built to replace all those clunky spreadsheets you've been wrestling with. ARI gives you clear cash flow and growth projections over 10 to 30 years, updates in real time with AI-powered data, and evolves based on your feedback. Whether you're new to investing or scaling up your portfolio, ARI helps you crunch the numbers like a pro. Access it now. Head to investorkit.com.au, link in the show notes.
So when cashing out, like you have a property that you own in your personal name, you do a cash out loan to purchase a property that's in a trust. What are some main considerations for clients to consider, of like, maybe some background about the technical side of being able to claim the interest within that trust? Like, what are some of the things to consider there?
So you can certainly draw equity from your personal home to fund the deposit for a purchase in a trust. Here, the ownership of the property lies in the trust. But the loan is actually in your personal name. So there's a distinction here. The ATO definitely wants to look at the connection between, you personally drawing that loan and then lending it to the trust for its purchase. So here we should have a loan agreement in place. We should have the trail of the money going from the personal loan to the trust and then for the purchase of the property. So that's number two that the ATO usually wants to see. And there's a clear trail for it in your personal name, because you've got a loan, you've drawn down the equity and you've loaned the money to the trust. If you want to keep to the same interest rate, the deduction sits in the trust. So the interest deduction falls in the trust, but in your name, it would be an interest income and an interest expense. So usually it would nullify, and we would tend to keep the interest neutral in the personal name and claim the deduction at the trust level.
Yeah. Makes sense. That's a big one. So people recognize that they're not increasing their interest deductions personally. They're nullifying that out because of the two vehicles, and everything sits within the trust, which, whilst it has a disadvantage against the personal claims, it has an advantage in the trust that once the trust as an asset, which likely you're purchasing in there in future, becomes positive cash flow one day, it's got a myriad of deductions that you can go against and use, right? Because that deduction's been carried over multiple years. Is that a fair understanding of that vehicle there benefiting you in the future, maybe just not right now?
That's absolutely correct. In most cases that we see, the trust usually has, you've got the property, you've got the loan, but the loan value ratio is usually quite high. So you've got a higher deduction of interest sitting in the trust, which ends up creating a negative gearing in the trust. So you've got losses accumulating in the trust. A trust cannot distribute losses, so they would accumulate in the trust until such point in time when you've got positive income in the trust, or you do sell the property and you've got a capital gain, which can be used to offset against those losses. So those losses are quite valuable. So you would definitely put through the interest expense in the trust accounts every year, accumulate it to that point where you start generating positive income, and you can then use those losses. So those interest reductions are very valuable for the trust.
On the topic of trusts, Ronesh, we have a lot of clients who are starting to continue to build their portfolio. They're looking to expand, and they're starting to think about whether trusts make sense for them. Now, you deal with a whole bunch of clients, and you are constantly assessing whether it makes sense for a client to go down the trust path. What are some common traits, whether that's their financial situation, their profession, where you're going, hey, these are some patterns that I'm seeing where it might make sense to go into a trust?
Sure. That's a wonderful question. It's a good question. We usually see with our clients, we've got a range of clients. They could be small, they could be growing businesses, or they could be high net wealth individuals who've got businesses, portfolios of investments. The trust is a very unique structure. It has various tax benefits. So if you use it properly, it has a multitude of benefits for you. And the first primary benefit of the trust structure is the ability to distribute income and capital gains to beneficiaries. It has a power of a family trust or a discretionary trust. And every year when there's taxable income, you can distribute it to lower tax beneficiaries within the group. And you can specify select individuals within the family group for capital gains as well. So that's a very powerful tool for distributing income from a trust structure. And clients that we've seen right across, they would build investment property portfolios in trust. They would build share portfolios within a trust structure. And it's a range of assets that a trust can have, as long as the trust deed allows for those range of investments. So it always comes down to how is a deed prepared? Does it allow for those investments? And in terms of having who is controlling the trust. So most of our trusts, we do have corporate trustees. So, usually for a couple, it would be the husband and wife would be the directors and the shareholders of the corporate, and they would be making the decisions. The other good reason of having a trust is for passing intergenerational wealth to kids. It's a widely used structure, trust, for building wealth, and then in the future, providing those assets to your kids long term as well. So it's either via through distributions or via the use of a will to pass on those assets. There's a specific trust that's used, which is called testamentary trust. So a testamentary trust is created by a will, and that's used specifically to provide benefits to certain kids in the family, kids who may have disabilities or kids who are minors. So that's a very powerful trust structure that's used widely with our clients.
So people, when they're transferring, like what you just mentioned, they can't do that with a family trust?
So with a testamentary trust, it usually comes into effect when someone passes away.
Gotcha.
So that's created mainly for death benefits and for
because the reason
assets,
that happens is because, is it as simple as just changing them to be shareholder and director of the trustee company?
You could do that. So you would follow the will and how the will dictates the trust is to be controlled. So you would, if you have a corporate trustee, then it makes life a bit easier. You could change the directors of the corporate to the new beneficiaries that are under the will.
So I'm learning this as we're talking. So when there's debt associated to a property, the lender, like if it's a trust and it's just being passed down to kids, the lender won't have to like do a reassessment on their ability to repay, right? Because when you're doing that, like if you're passing down something in your will and it's all owned in personal name, but it's got debt attached to it, that person taking over the title of the property and that loan would have to show that they can make the repayments and the ability to take over that loan. But in a trust like that, that's how they avoid.
Is that because the company hasn't actually shifted, right? It's the same companies as the people underneath it, so the title doesn't change.
Correct. There's still continuity.
Yeah,
and that's achieved by having a corporate trustee, and that's why we usually recommend having a corporate there for a trust.
There you go. That's a good one.
When my kids are watching this episode, I'm just gonna have to thank me.
Setting up those
all my
trusts
shits in trust.
Well, speaking of trust, Ronesh, on the mentions that you've had where people want to use them for those benefits, we've seen that you liaise with a lot of medical professionals as clients of yours. They seem to have a desire to go down to trust much more than other professions do. Are there any other reasons outside of those benefits why they may want to do that more often? Because we notice that quite often.
So with medical professionals, especially those they are in high-risk professions, there's always a risk of being sued. So a trust is, again, a asset protection structure, as you would call it as well. So you be able to build assets within a trust as opposed to having it in your personal name. Again, you get the asset protection, but again, if medical professionals usually are very high income earners, so paying tax at top rates. If you have those investment or growth assets in a trust structure, then the income on those assets and as well as capital gains can always be distributed to other beneficiaries within the family group. So it helps to diversify income and also help with the overall tax position.
Yeah, so they've got that tax side, the risk protection, the diverse income. What happens when you flip it the other way around? What I mean by flipping it is like people who you go, they've heard about trusts, they think it's sexy, they think it's cool, they're going to help their situation. But then it's like it's not that you're telling them, no, don't do it, but I guess it's more like there's more cons for them than not. Which situations present themselves like that where it might not be the best for someone to go into a trust?
Sure. That's it's always, pros and cons of a lot of things. But it always comes down to your or to the individual's financial situation and their circumstances. One particular example would be where a person is growing in terms of income, or they have a family and they have commitments. So you're looking at cash flow. Once you set up a trust, again, to purchase a property, and if you've got a negatively geared asset, then you don't get the benefit of the gearing because the trust cannot distribute losses. Whereas if they had that asset in their own name, they would get the benefit of negative gearing against their PAYG income and get a tax refund. And it comes to tax time. So you got to consider overall your cash flow position. Are you able to fund that asset in the trust structure whilst not getting the tax deduction personally? So it's all about timing and also regarding your personal financial circumstances.
How much does having beneficiaries weigh on the decision to set up a trust or not? Because I think, like, just from my view, if someone doesn't have any beneficiaries, like doesn't have any kids, doesn't have any parents, like, does that significantly reduce the efficacy of having a trust in the first place?
In my experience and over the last couple of years, it actually hasn't. We've got professionals who are, keen to go into the trust structure where they see the benefits in terms of being able to grow their portfolio and being able to acquire more properties. So it doesn't hinder. They're not definitely hindered by the fact that they don't have beneficiaries. But they're looking at growth, and a trust is a vehicle that does achieve that purpose.
Well, to back up what you're saying, we've got single Adrian Lee here with no kids either, and he's all trusted up and everything, true. And he's working through all these structures. So without even, pointing that out, you're spot on, like real life scenario right here, him going through that. And it's a very good point. So sorry if I just shouted out to all the ladies there, Adrian.
Bring up.
Look, Ronesh, thank you so much, mate. It's a pleasure having you here today because the world of equity loans, the world of trust, they're not as simple, just for everyone to comprehend and understand what goes on. And I think equity loans, there's so many common mistakes that happen without even people realizing that they're making them. So you gave them the real, cheat codes to focus on, which is don't get caught up on everything. Just focus on the purpose. It's the purpose that matters. And the easier you can prove that purpose, the better it is. Now, Ronesh, how can people reach out to you? Because we work closely with you a lot at Investigate, as does Foreca Financial, from setting up trusts, setting up SMSFs, managing accounting. Just because of your holistic guidance on property as well as accounting, it's not so much just solely that you understand both worlds. How can people reach out to you in terms of your team to get support from the accounting perspective?
Sure. No, we're always there to help clients of Investigate and Foreca, and to the public out there. We've got our website, Incentum Group, and people can go into the website and click on our client contact form and then send it through their details. We're always happy to have a complimentary chat with them and to understand the situation and how best we can help them out. So feel free to click on our web link.
Amazing. Thank you so much. We'll chuck that on the show notes. And for everyone tuning in, if you've stayed this long, you're well and truly a property nerd. So we thank you and appreciate you. Have a good one and catch you on the next show. Thank you so much for tuning into this podcast. To hear more like this and to help us spread the word, don't forget to leave us a rating and follow along for our next episode.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.